Mahesh Nandurkar joins us, Head of Research and Managing Director with Jefferies, and we'll take the conversation forward on where markets are headed and how does he map the risk-reward ratio. Mahesh, good morning. Thank you for joining us. Mahesh, what's your market view after the recent rally? Is it time now for markets to consolidate, or the upside in the market is still left in the near term?
Yeah, I think the markets have had a decent run, and my sense is that is not simply because of that reason that I think there could be a consolidation phase ahead, but also the other global risk that we need to keep in mind is the significantly higher U.S. Treasury yields, right? I mean, the risk-free rates in the U.S. have gone back up to the peak levels that we saw back in March. So when you are able to make a 5% risk-free rate, in the US, then that's obviously going to be something that will put equity valuations all over the world into a question mark. So that's one thing that we need to keep in mind. Also, from the India standpoint, I think the Indian inflation itself was, a big negative surprise. The last print that is, and my sense is that the inflation will probably stay at an elevated level over at least for the next, 1 quarter or so. So that will also push out the rate cut probabilities that some people were building in for the near term. So I think, yeah, those are the reasons why I think there could be a breather, there could be a consolidation phase in the market over the next, say, 1 to 2 quarters or so. But from a medium to long term perspective, things are looking very attractive. The capex cycle is unfolding. Economic growth is clearly standing out in the global context. So I think on that front, yeah, we are clearly very optimistic.
Mahesh, history indicates that if you buy markets at these juncture based on historical parameters, the returns in the long term, they get compromised, which is that rarely if you have bought market at 17, 18 times 1 year forward, you made double-digit returns. Do you think this time it could be different? Largely because the India narrative this time is very different, the construct of global equity is very different, and what has happened in the past may not happen in the future?
Yeah, good point, Nikunj. The thing is the benchmark for valuations have actually got changed, I would say, over the last 5 to 7 years. Not just in India, but I would say in the other parts of the world as well. So on an absolute basis, yes, the Indian market does look expensive compared to its own history over the last, say, 10 years or so. But if you take a look at relative valuations, as in relative to other emerging markets, other developed market, other Asian markets, etc., and yes, India is at a premium, but that premium is more or less at the average levels that we've seen over the last decade. So yes, on an absolute basis, the valuations are looking on a higher side, and your point is valid. But I think that valuation benchmarks have got changed globally and not just in India. And therefore, any global possible sort of correction in the markets, I think remains the key risk that we need to watch out for.
Paresh, wanted to understand, what do you think is driving mid-caps forward? And, I was just looking at your recent note where you think capex in housing is actually driving demand there. Elaborate a little bit about this theme to us.
Sure. So we do like mid-caps, small caps from a, once again, a medium to long-term perspective. And our preference and the reason why we like mid-caps is not because of the market capitalization. Necessarily that we like small caps or mid caps, not that. I think we like mid cap and the small caps for what they represent. I think the mid caps and small caps are truly representing the India story, especially in the context of the capex cycle upturn that we're looking at. See, if you look at the large cap names, large cap indices like Nifty, etc., you will barely see, just about 5% of the large cap index weight is in the stocks that are geared towards the property upcycle, the capex upcycle. But if you look at mid caps and small caps, that number goes up to 20-25%. So, also the proportion of domestic oriented stocks is much higher in the mid caps and small caps. Whereas in the large cap indices, you have several large commodity names and IT names and pharma names, etc., where the outlook is not necessarily as bright. So, yeah. So just to kind of make my point, we like mid cap, small caps because of what they represent, and they represent the true India story, and those stocks represent the industrial and the capex recovery story as well.
Interesting point that you are tactically overweight on staples. Now, just for the benefit of our viewers, staples essentially means you are bullish on FMCG stroke names like HUL, Britannia, that category. So, Mahesh, I wanted to introduce the meaning of staples for our viewers. Now, your view. Why are you overweight on staples? I mean, I thought they were expensive.
Yeah, sure. I do get asked this question quite a lot. So our structural, overweight ideas are on the banking side, the property side, the industrial side that we just spoke about. Staples is more of a tactical overweight for us, something that we would view to overweight, from the, let's say, the next 6 to 9 months perspective. The reason for that is twofold. One is that we believe in the rural recovery story. We believe that the rural markets have been weak for pretty much the last 2 to 3 years due to the pandemic impact, etc. But we are seeing slow signs of recovery over there. I think staples is one of the ways to play that. Secondly, we also expect that running up to the elections, we have seen some announcements coming from certain states, and I generally believe that running up to the elections, there could be some good news coming for the bottom of the pyramid as well. So I want to play that angle as well. And finally, staples is also a sector where we are clearly seeing the benefit of lower raw material prices reflecting in better EBITDA margins. So those are primarily the three reasons. But having said that, I would say that this is still a tactical bet. This is not a sector that I would buy and hold with a 5-year view.
You've expressed your thoughts on banks, but I want to go back to the price performance here. Whatever could go right is going right for financials. NPAs are low, credit offtake is strong, retail is picking up, there are no delinquency whatsoever, great managements are at play right now. Just about every bank has a good forward-looking CEO. Yet financials per se in this year have not given great returns. So is this one of those cases where everybody is bought into financials, and now what else could go right, and that is the reason why financials will not go in terms of stock performance?
Yeah, absolutely right, Nikunj. I think you hit the nail right on the head. Several good things are happening, and not just the ones that you mentioned, but also from the valuation standpoint. It is the only sector where the current valuations are in line with historical averages. For most of the other sectors, the current valuations are much higher. So even from the valuation standpoint as well, the private banks and the large banks are looking, quite reasonable. I think one of the key issues that we are facing at this point in time, and why the banking sector hasn't really done well, is the over ownership. A lot of people who could have bought have already bought. We're already seeing overweight in the domestic mutual fund insurance sector. We are seeing foreign investors are also overweight on banks. So we definitely need some incremental flows at the broader level for the sector to perform. But having said that, if you look at the stark difference between the large cap banks, I mean, the last 12 months or so, the large cap bank index is up like only 6%. Many of the other segments of the financial stocks like BFSI stock, be it the small finance bank, be it the NBFCs, or be it the small private sector banks, they've all gone up by 60-70%. So there is a huge gap that has got created, and I believe that banks is ultimately going to be one of the ways in which you can possibly play the capex story in an indirect way. Also, the other concern has been the pressure on the net interest margins, and the NIM margins are soon going to be bottoming out. So that's the other thing that we're watching out for. So yeah, on an overall basis, it's a sector that is looking very, very attractive from fundamental as well as valuation standpoint. So that's the reason why we have actually recently raised our conviction on the on the large cap banking space. In fact, we note that out of the top 6 large cap banks, 5 of them are trading below their historical averages. So I think that makes a case for decent return, because ultimately we're looking at most of these banks delivering an 18 to 20% ROE as well.
You think the exact opposite is playing out within the IT sector, that whatever could go bad has gone bad?
That's right. The stocks are holding up. So once again, I would say IT could be a good tactical bet in the near term once again, because as I mentioned, I do expect some kind of flattish movement, sideways movement, maybe slightly a weakish trend in the broader markets, and in that context, staples should outperform. IT would also probably be a sector where you will see some outperformance over the next 1 to 2 quarters. But once again, that's going to be a tactical bet for me, and not something that I would buy and hold with a, as I said, 2 3 year view.
So Mahesh, if a new client walks up to you, he said, "Look, I've been going to China, but I want to invest in India now. But there's a risk of election cycle, which is a genuine risk in terms of volatility. Should I wait for the election cycle to get over and then come at higher levels with little risk, or should I take the risk because the earnings are going to be so strong and supportive that the event of election will be overlooked?"
Yeah. So I think you're right. What is happening at this point in time is a lot of large global funds are taking that approach of waiting, on the sidelines, and that's visible in the numbers as well. I mean, we have seen that pretty much from September 21 till March 23, a long 18-month period, during which we saw the foreign investors net selling Indian equities to the tune of around 37, 38, close to $40 billion. That's a very large selling. Yes, we have seen some net buying since March over the last 5 months or so, but that's been very kind of narrow buying as such, and not really broad based. And we definitely see incremental interest coming in from global mandates or global investors, not the investors that are looking at Asian markets or emerging markets for long. In which case they have been allocating certain part of their portfolio, 15 to 20%, something like that, to India for a long period of time, and they've been tracking India quite closely. But it's the global funds that have not been tracking India very closely for for last 10 20 years or so, because India was a relatively smaller part in the global context. It still is, but the importance is clearly rising now. India is also the fifth largest stock market by overall market capitalization, and not just the top five in terms of GDP, but top five in terms of market cap as well. And we are seeing large ticket deals getting written out of India. And that's what many of these large global funds do watch out for, because they don't want to come to India and invest like 25, $50 million, $100 million. They want to write slightly bigger checks. And those kind of deals are now possible in India. So we do see incremental interest coming in from there, but many of those are still waiting on the sidelines. But if somebody were to walk up to me to answer your question, I would, just ask them to sort of, close their eyes and buy some of these large cap banks, which are trading at very attractive valuations. And obviously, the other sector that I mentioned is property and industrial. Those are also great stocks to own from a 3 to 5 year perspective as well.
Right. Mahesh, just wanted to get in a view. I don't know if it's fair to ask you, but what about fund flows from India to the US and then China now? We've heard from Jerome Powell on the sidelines of the Jackson Hole event. Inflation continues to be a concern. Similar is the picture for India as well. And then on the other hand, there are all the China bulls who thought valuations are cheap. They pumped in money, and year to date, they've not made any gains. But now with the stamp duty cut coming in, do you think, again, some of the money could move back to China?
See, what we've seen over the last, say, 2 to 3 years or so is that, every 3 to 6 months, there is this, point in time comes where the investors get drawn towards the attractive valuations, which many Chinese stocks are trading at. And, we see some initial spurt, and then, eventually something, goes wrong, and some of those initial expectations get belied. And we've seen what kind of has happened to that market. So I think many investors, to my mind, have also gotten tired of this once in 3 months, once in 6 month type of an event, which has now been happening for the last 2 3 years now. So yes, there will probably be some small, or I would say some near term attraction towards the theme that you just mentioned or you just outlined. But my sense is that there's a growing evidence and there's a growing investor perception that India is the structural story. So yes, maybe in the near term we see some ups and downs and maybe some sideways movement. But I don't think India, is going to fall off the radar of the global investors. In fact, if anything, as Nikunj also mentioned earlier, some of the investors are waiting for the to get some clarity on the election outcome. But ultimately, I think India will feature as one of the attractive markets.
All right, Mahesh, thank you so much for joining in and taking out the time to give us that view on the overall markets as well as the theme that you're really focusing on. Let's shift gears then and put the